We're seeing bank lending standards tighten up, and it's much more difficult and expensive to get credit for consumers, for small businesses. We think intermediate term right here and high quality fixed income, makes a lot of sense for most investors.
What about bank loans, leveraged loans, buyout debt, collateralized loan obligations, and then also private credit?
We're not enthusiastic about any of this. And if we're right that the economy continues to slow down, there's a non-negligible risk of recession. It's probably too late in the cycle to be that low in credit quality.
Today's episode is brought to you by MetaMask Portfolio. You'll be hearing more about them later on, but for now, let's get into today's interview. Very happy to welcome to Forward Guidance Kathy Jones, Chief Fixed Income Strategist for Schwab. Kathy, welcome to Forward Guidance. Great to see you. What has been going on over the past few months has been very exciting, and everyone wants to talk about bonds. We had a tremendous sell-off in October and a rip-roaring rally in November. How are you sort of thinking about the bond market in terms of how much interest rate risk you think is wise to take, as well as the drivers of when the 10-year yield goes up or down? What is sort of driving that move?
Yeah, and thanks for having me, Jack. I think in my mind, what happened in the fall from September to October when yields surged, we had a pretty strong third quarter GDP growth. We were seeing a lot of indications that the economy was resilient and rebounding and really taking off. And that economic surprise index really surged, and it changed expectations about how strong the economy is. Earlier in the year, we were talking about recession. By the third quarter, we're talking about, oh my gosh, 5% growth. And then, of course, that shifted expectations about what the Fed would do and other central banks. There was some narrative around Treasury supply, et cetera. But I think the main driver was really the surprisingly strong burst of growth that we had, sent yields up. And then all of a sudden, it was sort of like, oh, that was just a blip. We're back really to a slower growth environment. The jobs numbers are indicating, things are slowing down in the labor market, which is kind of the last shoe to drop. Inflation numbers have come down. So we've pretty much now taken out that whole move up from September to October. November's kind of corrected almost all of it. In terms of how much interest rate risk to take, we've been advocates of adding duration for people who are sitting in cash, and a whole lot of people have been sitting in cash or very short-term instruments. We've been suggesting adding duration kind of gradually as yields went up, on the idea that the Fed is going to do what it takes to bring inflation down, and that'll bring down long-term rates. And we continue to hold to that. The issue we face now is yields have come back so fast that I think it's hard to catch up. We still think an intermediate term duration, meaning something similar to the ag around 6, is a reasonable place to be. And no one's going to pick the highs and the lows in the market, but assuming you're in fixed income to generate income over the long term, we think intermediate term right here and high quality fixed income, makes a lot of sense for most investors.
And what will be the fundamental driver if your bull case on, let's say, interest rates plays out? Is it going to be slowing inflation, falling inflation? Will it be a recession? Does one or both of those things have to happen? Federal Reserve rate cuts. Will the Federal Reserve be willing or able to cut interest rates if there is no recession? That was somewhat of an open question a few months ago. I think now the Fed has made it a little more clear that they would consider doing that.
I think that our outlook is basically that inflation continues to fall. It's already fallen quite a bit. What we've seen is, say, the personal consumption expenditures number, that's a benchmark measure that the Fed uses, year over year on a holistic basis, it's down to 3%. Ex food and energy, the core reading is down to 3.5%. And that's been a consistent decline from the peak. I mean, it's down by over half, reversing much of what that spike in inflation occurred. And we expect that trend to continue. We continue to see softness in a lot of the leading indicators that would suggest inflation comes down. If you look at Energy prices, wholesale goods in general on the goods side, very soft. Import prices negative for 8 months in a row. We're seeing loosening in the labor market with job growth slowing down, wage growth slowing down. So the demand side in the service sector is easing. Service sector ISM starting to look a little bit softer. So we think that we are on our way to achieving that 2% inflation over time. It's not going to happen tomorrow, but we've gone from 7 to 3.5 pretty quickly. I think we can go from 3.5 to 2.5 into 2024, and that brings yields down. So the main driver to us is the slowing in inflation, which does go hand in hand with a slower growth economy. It doesn't necessarily require a recession. I wouldn't rule it out simply because there's a lot of tightening in the system. So we've had the Fed rate hikes. We still have quantitative tightening taking place. We're seeing bank lending standards tighten up, and it's much more difficult and expensive to get credit for consumers, for small businesses. And small businesses are responsible for most of the hiring that takes place in the United States. 75 to 80% of the hiring takes place at small businesses. So they're feeling the pinch in terms of credit availability, or just the cost of credit's really high. They're going to cut back on that hiring as well. They may not lay people off, so they certainly aren't going to add at the rate they were. So the demand side is slowing down. All the things that happen when monetary policy tightens are happening. And we think that that will continue to work its way through. As for the Fed, what does it require for them to cut rates? We do think they'll probably cut rates at some stage in 2024. We have not penciled in as rapid or early a pace of rate cuts as a lot of people have, or as the market's currently pricing in. We look for them to start cutting probably mid-year, around June, and to cut 3 times, 25 basis points each time. And that would be in response to slower growth, lower inflation, growing confidence that we're getting closer to the target rate. And if we hit a real bump in the road in terms of a mild recession, that might speed up, might accelerate a little bit. But I think that this is a Fed that's really reluctant to go too fast because they don't want to let inflation rebound.
Right. So you and your team at Schwab are looking at the Federal Reserve to do maybe 3 cuts in 2024, as starting as early as June. The market is ahead of you, thinking, that's not aggressive enough. The cuts could start, as early as March, and there's a small 14% probability, although the way these probabilities are calculated, who knows, that according to the CME, the Fed could start as early as January. Needless to say, not my base case, and certainly not your base case. But explain to me if your view on the short end of what the Federal Reserve is going to do over the next year or 2 years, if your view on the short end is you think rates will be higher than the market thinks, how then do you have a long view on duration? In other words, how do you think that the 2-year will go up? If you're sort of not bearish on the 2-year because you think the market is too aggressive in pricing in Fed cuts, why are you bullish on the 5-year or the 10-year?
Well, we think the inverted yield curve stays in play. So we're not seriously bearish on the 2-year in terms of, we still have 2 years for rates to come down. So, but I do think the 2-year's gotten ahead of itself. The short end's gotten ahead of itself in terms of pricing in Fed cuts. I know why, because we're in a normal cycle, whatever a normal cycle is, in past cycles, I should say, the Fed would be more forward-looking. They would be cutting faster. And we would have a forecast for them to start cutting in March and cut pretty aggressively given the trends. But one thing that informs our forecast is this Fed's reluctance to move quickly, their willingness to hold back. We've heard this over and over again from the Fed, even as they talk about the possibility of rate cuts, it's still very cautiously. And this is we don't want to be repeating the mistakes of the 70s argument. And so I think that while in previous cycles, faster, deeper rate cuts would have been appropriate and reasonable to forecast, we've specifically held back this time, respecting the fact that everything we hear from the Fed is they don't want to do that. Now, they may change their minds if things get really ugly, things start to accelerate to the downside, we hit some sort of a blip in the financial markets. I could see them moving faster and deeper. but we don't want to forecast that because we don't have any evidence that that's going to happen. So our base case scenario is that 2-year kind of sits here and trades in a range. 10-year though can continue to come down. 5-year, 10-year can continue to come down in expectation that the Fed will indeed lower rates over time, and that the longer they hold out at the short end, the more you get disinflation in the system. That should be favorable for the 5 and 10-year part of the curve. In other words, the tighter they are now, the more downside you have in inflation and growth, the more risk you have of recession, and that should be good for the longer end of the curve.
So, not to get too far ahead of my skis, but if you think that the curve will stay inverted, and you're bullish on the 10-year, not super bullish on the 2-year, let's put it that way, is it fair to say you think that the term premia will go down or return to being negative?
I think it will, go down. I think negative is a possibility, particularly if we hit a recession. It's really hard to forecast the term premium, right? It's sort of this, I look at it as a sort of catch-all for everything else we can't explain in the Treasury market. So, but the move up in the term premium was certainly a significant contributing factor to the rise in rates that we saw earlier. So some decline in the term premium would make sense. I think some of it reflects volatility and uncertainty about the path of short-term rates, right? And that is probably going to be with us in 2024. I don't think that volatility, that uncertainty generated by the Fed's reaction function is going to disappear. I think we're sort of saying rocky road, lower yields, but rocky road in 2024. Can't rule out a lot of bumpiness just because the Fed's reaction function is so out of sync with what I think most investors are accustomed to.
Thanks. So the Fed has hinted that not only might cuts be on the way, but that hikes are probably over. And the market is interpreting that as hikes are definitely over. Given that interest rates can only go one way, up or down, or stay the same, if up is off the table, does that mean that interest rate volatility is muted and that's kind of a room to ride?
Not yet. I think that the volatility to some extent is reflecting the fact that the Fed leaves the door open to more tightening. We also have the shrinking liquidity to think about, which can add to volatility. The Treasury market's not as liquid and easily traded. We get these outsized moves that come out of the blue from time to time. So liquidity is shrinking. We've got quantitative tightening, which the Fed thinks it can continue to do while it's, changing course and lowering rates. I have my doubts as to whether that's going to happen or whether that even makes sense, but I think it is a potential source of volatility as well. So I think volatility can come down from sort of the peak levels that we had last year, but I don't think it's returning to the kind of low levels we saw during the financial crisis or, ZIRP or even the 90s probably. It's probably not going to be that low.
And how are you thinking about where the floor is on rates? Really, maybe there is no floor. In Europe and Japan, 0 wasn't even a floor. But there's a so-called terminal rate about where the market thinks will be the highest, or in this case, the lowest rate. I guess we already are at the terminal rate for the height. But in terms of the terminal rate for cuts, where do you think, when the Federal Reserve is done cutting, what will that level be? And is that level higher or lower than the current market rate, which I can pull up right now, I guess?
Yeah, our view is that it's not going to go back to quite as low as it was because nobody really knows, right, what the natural rate is, the neutral rate is. We keep finding it, and it keeps changing with every era. But I'd seeing yields go down as far as they did in the last cycle seems unlikely to us. There are a lot of reasons for it to be somewhat higher. I think that the potential growth rate is probably higher than it was during, the great financial crisis era, during the pandemic era. Should be on the positive side. That being said, can the Fed end up lowering rates towards, 3%? Sure. Going down to 2% or even lower, that seems unlikely.
Right. But even if it's unlikely, if there's a 8% chance that interest rates go to 0, that could significantly affect pricing. And I think I looked up the market terminal rate thinks that the lowest the Fed will go to is like 3.3%. So around there. And how do you arrive at that 3% figure? Some folks say, oh, it's just nominal growth. What the 10-year should be is always nominal growth. I have a little bit of a hard time with that, given that GDP growth in 2021 was incredibly robust and off the charts, double digits, and the 10-year was 1.5%. How do you think about fundamental models about sort of the valuation of a 10-year relative to inflation growth expectations, which I know is it's pretty tough to model?
Yeah, so the old models used to work. Nominal GDP growth, 10-year yield, they moved together. There was a range around it, obviously, during the early 80s when we had so much volatility. That range was pretty wide, and then we settled into the 90s when it tracked pretty well. And frankly, modeling 10-year yields using nominal GDP growth and sticking in an assumption here or there and a bit of a lag, and you had a pretty decent model. That hasn't worked for a long time. And so we have not used nominal GDP per se as a strong factor in modeling 10-year yields. And the reason is it stopped working. It stopped being that easy or that clear cut. And we needed to take another look, especially once we went into zero interest rates, quantitative easing, all that, just threw all that out the window. But it was kind of diminishing as a signal before that. So we take nominal GDP growth into account because, it's still important, but it's not kind of the big factor that we use in modeling. So when we think about valuation, we're basically trying to take, what is the quote unquote neutral rate that we estimate and what is the inflation rate that we can plug in. And when we come down to it, we look at, if the neutral rate used to be negative, the neutral rate now, has moved up. It's in positive territory, but it's not the 2% that it was for 40 years. It maybe it's closer to 1%. We plug in 2% inflation, we've got 3% or so for the Fed funds rate. You add on, 100 basis points and a lot of ups and downs, and you've got a 10-year that trades between 3.5 to 4.5 as kind of a long run picture. Again, there's going to be a lot of fluctuations around that, but you have to start with some assumption, I think, on what the natural rate should be, what the neutral rate should be. That's the hardest thing for us to estimate because it keeps moving around on us.
So you first find the neutral real rate, so inflation adjusted rate, and then you take the inflation rate.
Right.
Okay, that makes sense. And what's your level of confidence in your long duration view, given the price action? I mean, does a move like this, in just a spectacular decline in yields over a month, does that occur during a bond bear market, for example?
So I've been doing this since the late 70s. So I have seen a few bond bear markets in my time, more than a few. And you see some of these spectacular moves. I mean, this level of volatility is something that harkens back to the late 70s, early 80s. And yet we're at much lower. We have huge moves, even though the yield levels are lower than they were then. You have these gigantic moves. And so I think that that's a little bit startling for a lot of people to look at that sort of volatility within the Treasury market because, it hasn't been the case for a very long time. But I do think that, maybe this is a rally in a bear market. I don't think so. We have a fairly confident view that 502 on the 10-year was the peak for the cycle. And the reason is the fundamentals are shifting. So if it hadn't been, first of all, we thought that was overdone. So we really liked them at 5%. We thought that there was too much of a narrative around supply, Treasury issuance, budget things, that rarely has a strong statistical correlation with the trend in yields. And so we thought that was just a narrative that was adding to the shakeout in the market. And there was this tremendous uncertainty about what the Fed was going to do. Now that we've shifted again and the fundamentals have kind of reverted to that slower growth, falling inflation scenario, we still feel good about duration. It's not as much fun as it was at 5%. When you're at 4.25 or wherever we are today, 4.17, I think was a low. But I do think that over time, having a strategy that targets an intermediate term duration where you lock in yields. So in the treasury market, we're looking at 4.25 or so, but you lock in yields on investment grade corporate bonds, in the 5+ area. If you're an investor and you're saying, I'm getting a 5% plus without a lot of risk, why wouldn't I want to do that for at least that part of my portfolio?
Today's interview is brought to you by MetaMask Portfolio, your one-stop shop to manage your crypto assets and access a range of Web3 services all in one place. Overseeing your crypto assets across different wallets and networks can be very complicated. MetaMask Portfolio solves this by giving you the reins to manage your crypto from a single decentralized application, or DApp. Just connect to MetaMask Portfolio to get a bird's eye view of all your coins, tokens, and NFTs, and you can easily buy, sell, swap, bridge, and stake crypto assets at competitive rates right within the app from a vetted list of providers. No more jumping between dozens of sites and apps. MetaMask Portfolio lets you do more in Web3 your way, giving you secure and convenient access to a wide range of features and services all in one place. Manage your portfolio your way with MetaMask Portfolio. Click the link in the description of today's episode to get started. Thanks, let's get back to the interview. Right, and I know there are sort of two schools of thought about what drives bond yields. One is it's only what we talked about, central banks and the underlying economy. The other school of thoughts, let's call that school 2, is yes, but supply and demand matters a lot. When the U.S. Treasury it issues a ton of bonds, the supply goes up, and if demand stays constant, the price will go down and yield will go up. And some point to the very aggressive issuance of the U.S. Treasury over the past few years, and they look at the rise in bond yields, and they draw that connection. So it's my understanding that you actually think that is the wrong connection to make. So someone who looks at, for example, the Treasury of General account and the quarterly refunding announcements, and they associate the pretty severe bear market in the summer and fall with coupon issuance, and then that one day, I think it was November 1st, where it actually was released. The data was released, and it actually was better than some investors anticipate. And then we have a month-long, basically, nirvana for duration bulls. Can you explain to someone who has that view why it may seem that way, but actually the statistical data does not support the connection?
Yeah, I know that I'm a bit of an outlier in this, but having started my career in a trading desk, there was always a view that as you approach auctions, this isn't the first time we've worried about the Treasury budget deficit, by the way. We didn't just wake up this year and say, oh my gosh, we're running a budget deficit. Treasury's going to have to issue more paper. Oh no, that isn't a surprise, right? We've known this for a long time, but it comes into focus from time to time. But having started on a trading desk, this was always the story that you kind of wait for yield to back up going into the auction, and then they would to clear the paper, and then they would, the market would rally once that was behind you. So I thought, well, this is a layup, right? I'm going to short bonds going into the auction. I'm going to buy them, and I'm going to have a great trade, a moneymaker, right? Well, when you do the work and you try it, it's a 50-50 kind of proposition. Sometimes they rally, sometimes they don't after auction. Sometimes they, rally going into auctions. Sometimes they fall going into auctions. And if you do the work on it over various time periods, and I've done 3 minutes to 3 months to, years, the correlation just isn't there. So yeah, sometimes it works and sometimes it doesn't. And so I am a bit of an outlier. I understand supply and demand. I understand that there has to be a clearing yield, but I don't think that the move last fall was really that tightly. It looked like it was tightly correlated, but in general, we also had a much stronger than expected economy happening in the third quarter, and those numbers were coming out And we had then this idea, this shift in expectations about what the Fed was going to do. And we had inflation fears building. And then you throw in Treasury supply and, it made a negative story in general. But I'm not going to attribute it solely to, that whole thing about issuance. Because again, people in the market are pretty smart. There were a lot of estimates out there. We all knew that there was going to be a lot of issuance. We all knew that once the debt ceiling dispute was over, things were going to come out. There was going to be more paper issued. This just isn't a big shock. So I guess, I'm an outlier in this belief, but having tried to make this work as a trade over the years and not finding a statistical correlation, I don't think that that's the whole story.
So you're making an empirical argument, just saying this isn't what I've seen, and the argument about why it might not work, because again, it's intuitive. More supply, consistent demand, or stable demand would cause prices to go down. You'll go up. Is that demand adjusts accordingly because it is anticipatory?
Yeah, to a large extent, and also the major drivers of yields is not how much the Treasury is issuing from one month to another, one quarter to another. Treasury is always issuing paper, right? I'm not saying supply and demand don't matter, but I don't think they matter in the way that a lot of people paint it, right? So we cleared at roughly 5%. There's sort of a story like, well, who's going to buy the paper? We've got so much deficit, there's so much coming. Well, it turns out that, maybe certain buyers step back, other buyers stepped in, households, mutual funds, money market funds. They would take as much paper as they could get their hands on at 5%. So the buyers shift around. And on the margin, the supply side can affect, who buys and what yield you need to clear. I'm not saying it doesn't matter. I'm not saying it is not that easy sort of correlation that people are making it. The U.S. Treasury market, there's a built-in demand from foreign central banks, major companies, individual investors. I mean, there is a built-in market for this that's hard to replicate anywhere else. So we're going to clear it. It's just a question of where do we clear it? And to have sudden spikes because we're issuing more paper, the idea that this is going to last or that this is the sole driver, I guess, to me, doesn't make a lot of sense.
Right. So you're saying it's not that supply doesn't matter, it's that only a surprise change in supply would affect things. In other words, if there's a $1 trillion issuance tomorrow that just came out of the blue, like lightning, that may make it. But pretty much everything else is priced in by the market.
I mean, I would say that the market adjusts to the level of supply that's anticipated pretty efficiently. So it would probably have to be a big shock. But it is one reason we're not looking for yields to go all the way back to where they were, say, during the pre-pandemic era, because we do have more issues, we do have more deficits to fund. And we have, on top of that, we have a political dysfunction that doesn't give us a clear pathway to dealing with it. And that, I think, is a factor to take into consideration that might keep that, term premium higher. It might keep that level of uncertainty higher. It might be that what goes into that catch-all that constitutes the term premium. But I think as a driver of market action, it's overstated.
Yes. And needless to say, in the early 2010s, there was so much ink spilled and discussions and hand-wringing about the national debt. And of course, the past decade has been a decade of declining interest rates and declining bond yields. And I also can relate to your point, because when the Federal Reserve is doing quantitative easing, they're buying bonds that should drive the bond yields to go down. But actually, bond yields tend to rise during that period. The only way I could explain that is because the Fed tends to do quantitative easing when the economy is weak, and coming out of a weak period, bond yields are low, so they would tend to rise. So fundamentally, the Fed buying $1 trillion of something tends to increase the price and lower the yield. So it's a really interesting topic. But talking about the Fed buying assets, the Federal Reserve is continuing to do quantitative tightening to roll off its balance sheet, to decline its holdings. earlier you said that you're not sure, you're not sold on the idea that that is sustainable. Why did you say that? And is it because do you think there could be some sort of accident in the market?
I think there's a range of possible outcomes. So, when I think about it in the most straightforward terms, I think about quantitative tightening as putting your foot on the brake, right, to slow the economy. And that goes with raising interest rates, another way to tighten policy. So they go together. If you now say, well, I'm going to keep interest rates high to put a brake on the economy, but I'm going to do quantitative easing, that wouldn't make a lot of sense. Same is true. If the Fed pivots to cutting rates because the economy is slowed down, that's putting your foot back on the gas or taking it off the brake. Why then are you using your other foot to step on the brake? It doesn't make a lot of sense to me. That these are two actions that go together. They reinforce each other. And it doesn't make sense to me that they would do that. I also think you have to be able to really calibrate that very carefully to not have a market accident, right? Not have a problem where liquidity dries up too much. And so I think the combination of sending a very confusing signal to the market and draining liquidity when you're, on the one hand, when you're trying to increase it on another, could cause some sort of pinch in the market as we've seen in the past. So it doesn't, to me, I know that the Fed really, is convinced it has the tools to do these actions separately. And I know there's a great deal of discomfort on the Fed's part to have a big balance sheet. It doesn't look good. They want to step back from the mortgage market. They want to have just enough to help the markets and the economy function without having too much. They want to stop, they want to be able to repay funds back to the Treasury as they have been doing for a long time. I understand all the motivations, but I don't know mechanically if it's going to work very well. And that's what has me concerned. So I think that it may be very difficult to do two things at once and calibrate it so precisely that you don't run into a problem.
Interesting. Speaking of mortgages, what are your current thoughts on I guess we could talk about whole loan mortgages, but mortgage-backed securities in particular, which I know maybe 1 or 2 months ago were at extreme levels of cheapness relative to like investment grade spreads or some other metric. I gather they've rallied a little bit, but to be honest, I don't know how much they have. So yeah, how cheap are they? Still at extreme levels, or are they only very, very cheap instead of extremely cheap?
Yeah, I would say that they're very cheap, but they're not extremely cheap. And so, I think the mortgage area has a level of attraction for a lot of investors, but I think you have to tread a little bit more carefully there, just because of the convexity issues, of the kind of liquidity issues that exist in the market. I think it's fine to have a position in mortgages. We kind of like them when they got really, really cheap. We think there's some room for them to improve from here, but I don't think that this is. I don't think it's going to be without volatility. I think there's going to be a lot of back and forth in that market to navigate.
And do you think that sort of the convexity priced into them is cheap or expensive?
And this is why I think you have to tread carefully, because this is a different mortgage market. This is a different housing market than we've had in past cycles, because so much of the market is kind of locked in at low rates. And so estimating prepayment streams or speeds is a little bit more difficult these days than it used to be. So, and I'm not sitting here with great confidence saying that I know what speeds are going to be doing and therefore how convexity is going to play out in that market. But I do think that I still think that they're reasonably priced for relative to, say, investment grade corporates, for somebody who has the willingness to ride out that volatility. And again, one of our themes for 2024 is, lower yields, but rocky road. I mean, no, there's no plain vanilla option here. There's no soft landing strawberry. I mean, we're going to be, we're going to be up and down. And that's, so I think, mortgages give us an opportunity where they're priced today. I wouldn't load the boat on them, because I don't have a high level of confidence that the market is at any moment in time pricing in the right level of prepays in their models.
What would you float the boat on other than what we talked about, that 5 to 7 or 6 year duration treasury strategy?
Well, we like investment grade corporates. We're looking at yields in the 5 to 6% area, investment grade corporates. Now, most of that's triple B, but assuming the economy doesn't fall into recession, we get a huge default cycle. Investment grade at those levels look pretty attractive to us. Spreads are low. They haven't really widened very much, but in investment grade, that shouldn't be too big an issue. At the upper end of high yield, if you're willing to take some of the risk there, I certainly would stay away from triple Cs. But it looks like in the high yield space, a lot of companies have been able to refi or to continue to push out the maturity wall to 2025 or so. So corporates, I think, offer some opportunity both for yield and for capital gains. But again, sort of up in credit quality. For high people in high tax brackets, munis, and you can go a little further out in munis. Oh, the other thing about corporate is that the yield curve is positively sloped there. So it's either flat or positively sloped. So you get a little bit more yield for going out a little bit in duration. Yeah, municipal bonds, if you're in again, I'd have to check again, but, if you're in a high tax bracket, you're looking at tax equivalent yields that are north of 5%. For somebody in New York City, could be even a little bit higher than that. So in California, so the really high tax areas, I look at pretty decent yields. And usually the buyers in the muni market are individual investors who are looking to lock in income, tax-exempt income, and we think that can make a lot of sense. You can go a little bit further in duration there without giving up too much in yield.
Hey everyone, we're about to get back in the action, but before we do, let me give you a lowdown on what's been brewing at Blockworks. Come March next year, in the heart of London, we're bringing together hundreds of the world's heavyweight asset managers. I'm talking about the big hitters, fund managers, allocators, payment providers, and the major high-frequency traders. They'll all be converging at Digital Asset Summit London, the mother of all digitally focused conferences in the institutional space. If you're curious about what the big money is up to in the digital asset scene, this is the event for you. We're diving deep into the intersection of macroeconomics and crypto, dissecting where we're at the market cycle, and we'll be getting into the nitty-gritty of real-world assets, so think stablecoins and on-chain treasuries. It's all in the mix. I'm going to be there, and so are the Forward Guide superstars. Michael Howell is going to be there. There's a rumor that Joseph Wang is going to be there. I don't know who started that rumor, but people are saying that. We're also getting into the minds of allocators, so you get a front row seat to what the big crypto money managers are cooking up these days. And because you're a dedicated Forward Guidance listener, here's an exclusive treat. Use code FG20 to get 20% off. Just hit that link at the end of this episode, so gear up, because I'm looking forward to seeing you in sunny London town come March. Thanks, let's get back to the interview. All right, thanks. And then leaving the world of duration and going more into the world of credit. So you said you don't like the triple C, high yield bonds. What about sort of bank loans, leverage loans, buyout debt, collateralized loan obligations, and then also private credit, which I don't know anything about, but apparently watching TV, it's the hot new thing.
So we're not enthusiastic about any of those. So, and there's a couple of reasons. So leverage loans, bank loans, short duration and high yields, very low credit quality. So and also a lot of the attraction there, of course, is the floating rate. So if the Fed is done, you've kind of missed, that's behind you. You kind of missed the boat if you didn't take advantage of that. So now you have pretty much mostly credit risk. And if we're right that the economy continues to slow down, there's a non-negligible risk of recession. It's probably too late in the cycle to be that low in credit quality. There are liquidity issues there as well. And my concern is that the market really hasn't priced in what it means to some of these companies to roll over their debt at 8, 9, 10%. And the covenant quality has really gone down. As an investor, in the event that you end up with some sort of restructuring, you may end up with PIK bonds, payment in kind bonds. You may end up with equity. That is probably not why you bought in in that market. You've probably bought for the yield, and that's not likely. You're not likely to earn what you hope for in that market. So we're pretty cautious on the leverage loan side and on bank loan side. When it comes to private credit, it's very popular, but there are certainly issues that I think you really have to pay attention to. One is the opaqueness of the pricing. So they don't have to mark to market. So you really don't know what the valuation is unless you can go in and examine it and do the analysis yourself, which most people can't do. Every private credit manager that I've ever heard speak talks about how they've got it all under control, and they're not going to have problems. But in reality, things happen, and not everybody can be this little Lake Wobegon story. Everybody's above average in that market. Well, if we do hit a bump in the road, so you have companies that need to refinance at higher rates. Some of them are doing loans against loans right now, more financing against financing problems. And
what does that mean, a loan against a loan?
So you say you have a loan, and you're these companies, and the rate's gone to 10% and you can't pay it. You'll get another loan to help pay off your loan, borrowing from Peter to pay Paul. And there's a lot of concessions that have to be made there. And that's leverage upon leverage. And these are supposed to be bridge loans to get you to the other side. But, we don't know, is that other side 2 years away? Is it 1 year away? Is it 5 years away? Does the company have the staying power to stay in business with this kind of funding at these higher and higher rates? And so I just would tread very cautiously in private credit. It's very hard for investors to really know what they're getting, and liquidity can dry up pretty quickly. So again, we're kind of late in the cycle, and so credit quality, when borrowing rates are this high, is more likely to deteriorate quickly. I'm sure it has for a lot of these borrowers, and how they get out of it is the big question mark. And so because of the opaqueness and the pricing, as an investor, you're just putting your money in and saying, okay, I'm trusting you to take care of this. Is your rate of return going to be what it was for the last 5 years? Maybe, maybe not.
And do investors know what they're getting into? In other words, the marginal dollar going into private credit, who is it from? Is it from institutional allocators at endowment funds? Is it wealth managers? I'm not making a comparison at all to the great financial crisis, but a hallmark of there is exceptionally sophisticated products being bought by clients who maybe didn't understand what they were getting into. Again, not making a comparison, but do people understand that it's not the same thing as buying a bond ETF, for example?
Yeah, I hope so. I would think they do. I think most usually have to be, for individual investors, have to be a sort of qualified buyer in a wealth area that qualifies you to buy them. I think in most cases anyway. Do people ever really know what they're buying in a more complex product is always the question, right? Does everybody know everything they need to know when buying in? Probably not. I think there are institutional buyers. I think some of the big pension funds are sticking with the strategy and even allocating more as time goes by. There are certainly, fund managers, et cetera, who are looking to boost total return that way. And wealth managers who are looking to satisfy a desire by a lot of clients to have something that will be uncorrelated with other assets. The story being, well, 60-40 didn't work for a couple of years, so I need something else, right? But I'm a fixed income person, so I am by nature somewhat skeptical. And so for me, I don't know who needs this product, but I think that if it's something people want to go into, a lot of education, a lot of disclosure around what it entails, how it's going to be managed, who's going to be managing it, what the range of outcomes is. I think that's warranted.
Right. And I guess the new word people are talking about is debanking, and it's private credit replacing a lot of the lending activity of banks. I suppose one positive to financial stability is there, can't really be a bank run on a private credit fund because clients have their money tied up. So from a systemic point of view, that's good. But yeah, how do you think that in other words, is there a hole left by banking that private credit needs to fill? Because I'm speaking as someone who, following the lots of activity and the volatility in the banking sector, let's say in the spring and summer of this year, and for a while, money was leaving the banking sector extremely quickly, deposit outflows, and so banks are reducing their loans or reducing their loan growth, I should say. And so private credit stepping in to fill the void. Do you think that will continue, or do you think that banks rebound will have a comeback?
Private credit will be around, filling in gaps. The banks, regulation is stiffer than it used to be. And certainly this episode last spring was a motivation for being more conservative in their lending and pulling back on some of the riskier parts of the market that are now being filled by private credit. But I think private credit's around to stay. Does it need to be there? Well, it is there. I don't know what it needs to be there, but it is there. And I think there is a push at the SEC and other FINRA, et cetera, to kind of look a little deeper and say, okay, well, what does this mean for the overall financial system? Because even though, you get a run on a private credit fund, it shouldn't have a massive effect on the economy. But is there contagion? Does one thing spread to another? When one fund is running into trouble, does another fund have trouble? Is there enough cash available to kind of fill this hole, a hole that might be created? Or what are the ripple effects? And I think that's the question mark around this very strong growth in private credit. What are the ripple effects of a problem that might run through that market? And I don't have the answer to that, but I do think that's probably something we're going to see the regulators look at pretty carefully, saying, do these big fund companies have the cash cushion? Do they have the liquidity? We know that you're locked up, and so the gates can go up, but we also know that at times when somebody's locked up in one place, they try to get money from another place to fill the gap. And so what are those connections? What is that potential contagion? Is probably something that the regulators are looking at more closely.
Very interesting. Returning to treasuries and bonds. So you laid out a compelling case for why interest rates, bond yields could continue to decline. How do you think about positioning? I've seen and heard of a few sentiment polls, investor surveys showing that bond positioning is actually quite long. In other words, clients actually agree with you. However, but that means that there's no one else to agree with you. In other words. So how do you assess the current bond positioning, and do you think the positioning and sentiment supports, or is a challenge to your moderately bullish view on rates?
So I don't usually take sentiment into account heavily, and the reason is that, again, like a lot of other things, I've tested it over the years and it hasn't worked very well for me. And also because the bond market is so large and dominated by so many large players, that sort of investor sentiment is more marginal impact than, say, it might be in the stock market, I think. But having said that, although I think some positioning has gotten long, I can only judge by what I see among our client base at Schwab. A lot of people have started to move out in duration, but a lot of people are still kind of cautious and waiting in very short-term paper. And because it pays more, right? If you can get 5%-ish in very short-term paper, why go out longer, take the risk, especially after the volatility we've seen over the last year. And so I see a gradual move. So I don't know what sentiment's doing, but what I see is a more gradual approach by a lot of people. I'm not seeing a headlong rush into long duration. I'm seeing more caution. Now, maybe positioning in some of the ETFs, the leveraged ETFs, et cetera, has gone. And those are probably people who are more trading oriented. But from a long-term sort of investor sentiment, it's been a much more gradual move than would be implied by some of the other indicators.
Got it. Thank you. So I know a lot of the work you do is focused on the U.S., but scanning the globe in terms of bond yields and interest rates, Does anything stand out to you that is, you're you bullish on duration, everywhere on the world? Or is there, a difference? Mainly, the Federal Reserve, what the Federal Reserve do, that's going to have a lot of impact on U.S. bond yields and global bond yields. But the rest of the world certainly has an impact too. So I guess we talk about Europe and Japan and European and Japanese investors in U.S. Treasuries. Sort of, what is their appetite? What is their exposure? I know for a time, Japanese government bond yields yielding zero, U.S. Treasury yields yielding up to 5%. That seemed attractive. But actually, for investors who were to hedge their currency risk and hedge their dollar risk, it actually was like a negative pickup, maybe to do with the curve. So, yeah, just what are your views on non-U.S., Europe, Japan, or anywhere else that you think is very interesting?
Yeah, I think developed market yields will fall, led by the US and well, maybe led by Europe because things are developing much more, growth is slowing much more quickly in Europe than I think was anticipated by the European Central Bank. And Germany kind of testing a recession, all of Europe slowing down faster than expected, which really, I mean, not too big a shock because a lot of what happened in Europe was the supply side shock that came from the energy. So it wasn't a demand-driven inflation shock. And so now that the supply side is returning to a more normal setting, demand never really took off that much. So the response of the ECB was probably overdone. And I think they will probably be the first to cut next year. So we do see European yields coming down, but I also think the euro will probably come down a little bit with it. Not dramatically, but you have to take that into consideration if you're looking at European bonds. Similar story with Canada, Australia. Canada's got a property market issue that we think will result in the Bank of Canada having to ease rates at some stage of the game sooner and more aggressively, say, than the US, because the property sector is more affected by the change in mortgage rates. So we think that's a potential for some return there, but again, it'll affect the currency. Japan is kind of a different story because you have the Bank of Japan talking about exiting yield curve control and allowing yields to go up, and they have gone up. At the same time, the yen has been all over the place, initially stronger, then weaker, really moving. And as you said, that hedging is still relatively expensive for foreign investors and for Japanese investors in the US. Not as expensive as it was, but it does diminish some of the yield spread. So Japan's a different story. I think that if there's a story in 2024 around international yields, it's going to be around the Japanese bond market and the potential for yields to go up and the yen to recover as well. So that's going to be tricky for a foreign investor in Japan.
So as bond yields decline, or if they decline, who do you think the marginal buyer will be? If we have, the banks, the insurance companies, central banks, if they, resume quantitative easing, which I'm not saying that they will. Obviously, it will be a combination of all those parties and more, although maybe not including the central banks. But is there any sort of area where you think there will be a particular pickup in a strength of who the buyer will be?
I tend to think that domestic investors have been underinvested in U.S. bonds for a while. And so I think that probably, if there's a marginal buyer stepping in when yields are attractive, it will be domestic retail investors, mutual funds, et cetera. I think they've been underallocated, particularly if there is a setback in the stock market. Now, I don't know what's going to happen with the stock market, but I think rebalancing may come back into favor after a couple of years when, there's no yield in bonds, everything's in stocks, et cetera. Now there's yield. I think that probably the marginal buyer on upticks in yields will be probably domestic investors, so the retail investors through the mutual funds and ETFs.
Got it. And you referenced earlier, you are somewhat bullish on the dollar. Is that correct? Or at least against the euro? My
view on the dollar was, we were in a 10 or 11 year bull market. I hit the peak, have come down a bit. I think there's a bit of room here for it to come down some more if the Fed leads the cycle on the downside, but I don't think there's much downside in the dollar because there's more downside in growth outside, particularly in Europe from here. And China's been soft. So I think the dollar, it's probably going to bounce around and consolidate here, but it probably has a bit more upside from where it is now because the market's built in, the Fed's going to be aggressive and lead this rate cycle. And now it's looking like, no, maybe not. Maybe ECB is going to lead the rate cycle. Maybe, we've got more risk of recession outside the US than in. And those capital flows into the US have continued to be very, very strong. So I think that if we continue to grow at a margin, even a small margin to the rest of the world, rest of the developed world, that will probably continue to bring those capital flows in. So I don't see a huge downside to the dollar. I see some upside, but it's going to be more moderate this year. It's not going to be a major bull or bear market in my view for the dollar this year.
So you think the ECB could cut before the Fed? That could be a big deal. I could see the dollar rallying a lot.
Yeah, I think it's possible when you start looking at the numbers there. And I think somebody from the ECB was out today saying, well, maybe we've miscalculated. Inflation has come down a lot faster than we thought. I think it might have been Isabel Schnabel. So,
it was a pretty big hawk. So when you see, like the Waller of Europe.
Right, exactly. But if that's the case, then, that's an important pivot that could take place. Justifiably, I think Europe is much weaker than the US in terms of economic growth, and inflation is probably headed lower there faster than had been anticipated by the ECB.
Well, we'll leave it there. Kathy Jones, thank you so much for joining us and sharing your views, your insights, your time. People can follow you on Twitter at Kathy Jones, where you share a lot of very interesting and insightful charts, data. Thanks again, and thanks everyone for watching.
Thank you for having me.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined.